Hey everybody, welcome back. We're on Unit 6.6, Real Interest Rates and International Capital Flows. Basically what we're going to be doing is looking at how changes in real interest rates affect international capital flows. In fact, what we're really going to be doing in this video is going through all of these scenarios and seeing how these scenarios affect financial markets in the U.S., the interest rate in the United States, therefore international capital flows, and therefore the current account also, or net exports, okay? Here's the deal, guys. We're going to look at the United States doing expansionary monetary policy, U.S. doing contractionary monetary policy, U.S. doing expansionary fiscal policy, and the U.S. doing contractionary fiscal policy. Each of those separately. We're going to look at each of them separately, see how they, again, affect the financial market, therefore affect the interest rate, therefore, again, affect international capital flows, which then affect the product market in the United States, okay? And when we are done with each scenario, we're going to answer these 7 questions. So let's get to it. Let's start with expansionary monetary policy, again, in the United States. That'd be the U.S. Central Bank, the Fed, pushing reserves into the financial markets, increasing their lending ability. When they push those reserves into the financial markets, we would expect the interest rate to go down. So the interest rate goes down in the United States. How is international capital flows going to react to a lower interest rate in the United States? Well, people who have money, think kind of savers if you will, they're going to want to go put their savings into other financial markets. So we're going to see money going out of the U.S. financial market. I like to say that money flees from low interest rates. Money goes to higher interest rates. So again, if the interest rates are going down in the United States, money's going to come out of this, okay? Now, as money comes out of our financial market, it means there's an increase in supply of dollars to the exchange market, right? Hey, U.S. savers who have dollars are now taking those dollars to the U.S. exchange market to exchange them for some other currency. So we see this increase in the supply of dollars. So, increase in supply of dollars is happening there, which means they're demanding more foreign currency. Well, what's going to happen to the dollar? The dollar is going to depreciate. Now, when the dollar depreciates, what's going to happen? Well, the goods and services here in the U.S. product market are going to become cheaper to the rest of the world. So here's what's really going on, is you see these dollars heading to the exchange market, and then they're getting rerouted to the U.S. product market. Because again, this movement from a financial market standpoint is causing the dollar to depreciate. And that dollar depreciating, as that dollar loses value on international markets, the goods and services in America become cheaper. So these dollars are going to come out this way by Americans, and they're going to hand them to Europeans or anybody else in the rest of the world who wants to go buy those U.S. products that are now cheaper. So you see this kind of movement happening right there. Again, the dollar is going to depreciate because what's initiating this is the interest rate change here. That's what's initiating this. Interest rate change here causes this increase in supply, and then the dollar dropping in value is what causes the money to flow into the product market for the United States. Let's go through this. Increased supply of dollars. We already said that. Less demand for dollars. Okay, why less demand for dollars? Interest rate went down. Savers over here don't want to put their money there. If they don't want to put their money in the U.S. financial markets, they don't want the dollar. Less demand for dollar. Both of these things cause the dollar to depreciate. Now, let's look at our money flows. Money coming out of the U.S. financial market. That's a debit right there to the financial account. Then money getting rerouted to the U.S. product market. That's going to be a credit to the U.S. current account. U.S. exports. Again, this is money that's going that direction. The goods and services are going to be going abroad. U.S. exports are going up. And again, since foreign currencies are appreciating, since the dollar is depreciating in terms of foreign currencies are appreciating, this stuff is more expensive. U.S. imports dropping down. Okay, now let's get rid of those arrows right there. All right, because we're done with the first scenario. Let's go to scenario 2, contractionary monetary policy. Now the U.S. Central Bank, what are they going to do? They're going to be pulling reserves out of the financial market. So they're pulling those reserves out of the financial market, reducing the lending ability of banks, causing interest rates to climb, interest rates to go up. When those interest rates go up, financial capital is going to flow that direction to the U.S. financial markets. Money's going to flow to the U.S. financial markets, right? So the interest rates go up, money's going to flow that direction, if you will. So money's going to come this direction. Now, of course, when that money starts coming this direction, what's that going to cause the dollar to do? That's going to cause the dollar to appreciate, right? And when the dollar appreciates, the stuff here is going to become more expensive. In other words, from a European standpoint, when that money comes out, it's going to get redirected that direction right there. And what that means is when this stuff becomes cheaper, right, it's causing the dollars to be redirected that way. If you don't understand this arrow right here, I understand it. Let me explain it a little bit better, okay? So here it is. Interest rates, what did they do? They went up in the U.S. financial market. Gets the European saver to come out, demanding dollars, causing a shortage of dollars, causing, again, the dollar to appreciate. That dollar appreciate makes those things look cheaper to Americans. That gets the American to come on out with those dollars. This is like an arrow going that direction. The dollars come out. And where are these dollars going to go? These dollars are going to go into the hands of the European that is coming this direction, that again wants to put their money in the U.S. financial market to earn the higher interest rate. I hope that makes sense to you. Okay, so that money goes that direction. You can see the arrow going just like that. So let's take a look at this. Supply of dollars. Remember, interest rates went up. We're not going to supply our dollars. We're going to keep our dollars going right into this financial market. Savers are going to take more of their savings here because the interest rate's higher here. Decreased supply of dollars. Also, demand for dollars. We know what's happening, right? The European savers are going to want to get their savings over here. To get their savings here, they're going to need dollars. That's an increase in the demand for dollars. So what's the dollar going to do? It's going to appreciate. Both of these things cause the dollar to appreciate, which we said, it's right there, right? The dollar is going to appreciate. Now, financial account, from a United States standpoint, credit. Current account, debit. If you went to Europe and you said, hey, financial account, you would see that debit to their financial account, credit to their current account. And then U.S. exports. Hey, the money's going this direction. Remember, the dollar appreciated. Remember, this stuff is now cheaper to Americans, and since that dollar appreciated, our stuff is more expensive, right? So U.S. exports is going to go down, U.S. imports up. We answered all 7 for contractionary monetary policy. Now, I'm going to start doing it a little bit different. Now that I've done those two, I'm going to be a little bit more simplistic in my arrows because we should kind of have this down now. All right? So let's get to expansionary fiscal policy. So the U.S. does expansionary fiscal policy. Again, this is going to cause deficits for the U.S. government budget that the U.S. government is going to have to finance. Where do you go finance something? In the financial market. So the U.S. government, when they're doing this expansionary fiscal policy, this deficit spending, right? They're going to have to finance those deficits. So they're going to need to demand loanable funds here. Some people call it a reduction in the supply of loanable funds. That's fine. I like to call it an increase in the demand for loanable funds. The government needs these loanable funds. So what's going to happen? That's going to drive interest rates up, right? Expansionary fiscal policy drives interest rates up. Now, how I'm going to draw it, okay, is a little bit different than how I've been drawing it, because this is where we eventually want to get. We say, hey, interest rates are going up in the U.S. financial market, money's going to come that direction. And then when I do that, I immediately want to say what is happening to the dollar, okay? That is going to cause, money comes this way, people are going to need to demand the dollar here, right? They're bringing their foreign currencies to this market, demanding the dollar. The dollar is going to appreciate. And that dollar appreciating is causing that flow from a product market or current account standpoint, okay? That's a little bit simpler way of doing it. And let's just also put the euro here, or foreign currencies, if you will. So since I have European Union, I'll go ahead and put the euro. This is an increase in the supply of euros. That's going to cause the euro to depreciate, which complements what we already said, right? The dollar's appreciating in terms of the euro, so the euro is depreciating in terms of the dollar. So this action, okay, remember, it was the interest rate change that got this flow, which changed the value of the dollar and the euro, right, which means the same thing, which caused that flow. So now we can answer those 7 questions. Supply of dollars. Interest rates went up here. Savers are staying home, or at least staying home more, right? So since U.S. savers are staying home more, supply of dollars decreased. Demand for dollars. You can just see it. Hey, here's the Europeans bringing their currency, demanding dollars. Okay, they're bringing their currency because they want to get their savings over here. So they bring their currency, demanding the dollar. Once they get the dollar, then they're going to take those dollars into that financial market, right? So demand for dollars is going up. We've already said value of the dollar, it's right there. Dollar appreciated. Financial account, just look at the arrow. The money's going in. That's a credit to the U.S. financial account. Current account, you see the debit right there. There's a debit in the U.S. current account. U.S. exports, go to the product market for U.S. exports, right? Goods and services. The money's flowing out. We're going to go buy imports. Again, our dollar appreciated. Our goods and services are more expensive to the rest of the world. Our U.S. exports are going down. We're going to buy those goods and services from abroad. U.S. imports are going up. Okay. One last one to do, okay? Let me get rid of my arrows real quickly. so I can do it one more time. We got contractionary fiscal policy. Now, contractionary fiscal policy, reducing government purchases, reducing transfer payments, maybe increasing taxes, whatever. We're reducing the deficit of the United States. We're reducing the U.S. deficit. Could even cause ourselves to go into surplus, okay? When that happens, what happens here? I like to think of it as a decrease in demand for loanable funds right here. A decrease in demand for loanable funds is going to cause the price of loanable funds to go down. So decrease in the interest rate. Again, I'm talking about contractionary fiscal policy. Okay, expansionary fiscal policy causes interest rates to go up, which hurts the goals of fiscal policy makers. But this one is contractionary fiscal policy. It's going to cause the interest rate to go down. All right. Now, when that interest rate goes down, here's where we're supposed to be at this point, guys. You go, oh, interest rate went down. Oh, money doesn't like low interest rates. Borrowers do, but borrowers don't have money. Money likes high interest rates. So you immediately say money's going to flow that way. Now, when money flows that way, you can see the supply of dollars right here increasing, which means the dollar is going to depreciate, which means the foreign currency, which I have as the euro right now, is going to appreciate. When the dollar depreciates, it makes this stuff cheaper, right? When the euro appreciates, it makes that stuff more expensive to Americans, right? So what's going to happen? Money's going to flow that direction, all right? That way. So let's answer these. Supply of dollars. The interest rate went down, right? The interest rate went down. That's going to cause Americans to supply their dollars here, right? That's what's important. We're going to see them go supply their dollars here as they want to get their savings over here. Increase supply of dollars. Again, interest rate went down. People in Europe aren't going to want to put their money here, so they're going to demand less dollars as they supply less euros, right? They don't want to bring their euros over to the exchange market to get dollars to put their savings here because they don't want to put their savings here, right? So less demand, which means what's going to happen? The dollar is going to depreciate. Both of these tell us the dollar is going to depreciate. Financial account, you can see the debit, right? Current account, you can see the credit. U.S. exports, this is money coming in. The dollar depreciated. This stuff is cheaper money coming in to buy our goods and services. U.S. exports up, U.S. imports down. Guys, hopefully what you're seeing is the interdependency between the financial account and the current account. Okay, when that real interest rate changes, it's going to have an impact on the financial account, which is going to have an impact on the current account. Here's what I like to say. When that real interest rate changes, it's going to cause the curves in the exchange market to shift, which is going to cause either a surplus or a shortage of the currency at the existing exchange rate. And then that exchange rate is going to change. And when that exchange rate changes, that's going to change how much these goods and services cost to international consumers, okay? Because international consumers look through the exchange market to see the prices of goods and services abroad. It's like a lens that translates the prices of goods and services in a different country, currency into the currency of their own country. I hope that made sense to you. I know that was a lot. And hopefully I'll see you in the next video. Thanks for tuning in.